Good afternoon, folks, and thank you for joining us today's episode of the FinTech Forward podcast series. Today we have a very special guest, Nathan Abadi from Greenwich Capital Management. I'm your host, Stephen Moeller, founder and CEO of Fluxion AI Solutions, curating customized AI solutions for business. Fluxion AI, your trusted growth partner. Our guest today, Nathan, is the CEO of Greenwich Capital Management. He's been in the financial technology space since 2010, starting with American Allied Funding as a working capital solution for small businesses doing credit card splits. In 2013, he founded Excel Capital Management, which was a broker working on multiple financing products for merchants. They performed MCA, term loans, SBA, AR financing, and equipment financing. In 2017, he founded GCM Capital as a direct working capital solution for small to medium-sized businesses, primarily to service the Excel deal flow at the time. During COVID, they then shifted their focus to 100% on their in-house funding solutions. His firm, GCM Capital, offers two primary working capital solutions. One, the purchase line product, which establishes a max approval amount based on the average sales of the company, wherein they purchase a fraction of future revenues, and the client can elect to draw down funding in exchange for GCM Capital to be remitted a percentage of future revenues until the contract amount has been completed. Or option two, their MCA product that allows merchants to get funded fast and has a set cost of capital. So, Nathan, thank you so much for joining us today. We hope you're well. We're excited to speak to you. And if you would please just kind of tell us a little bit detail about your background. You've obviously done some very exciting things. You've founded companies and have been successful, but maybe share a little bit about what that was like and a few highlights.
Sure. Well, thank you very much, Stephen, for having me on the podcast here. And been quite a journey to get to where I'm at. Over the last 16 years or so, traversing, the economic and financial headwinds and tailwinds that occurred. As far as the background on what we've done and what I've done to get where I am, there's been ups and downs. I started in this space in 2010 after managing a hedge fund, which was a very cool opportunity. I did it for about 5 years out of college. Came in as a low on the bottom of the totem pole, and then quickly became manager of the entire fund by the age of 23 at the time. I was mostly doing sell-side trades for the hedge fund and pricing out all the transactions. During 2008, during the recession, there was a lot of turbulence in the finance market. A lot of rules and regulations changed during that time period. Dodd-Frank essentially made that whole business obsolete by 2010. So I had to pivot. In 2010, we decided to move the funds from the hedge fund and enter into this space. It was a tiny little baby at the time. The technology didn't exist. There was, just the split, as we called it back then, which was the capacity to split a percentage of credit card sales into our account when we purchased their specific credit card transactions, a percentage of those. That model was very challenging. It was good because, we were able to board more merchant accounts, and there was additional revenue streams associated with it. But it was very limited in the scope. Things didn't work out as I wanted to. I kind of cut a bad deal with my old partners and decided to venture off in 2013 and launched Excel Capital. Excel Capital was my baby for a very long time. We grew the company from, 3 employees to over 20 employees during COVID, more than 20, probably like closer to 30 with admin and management. It was a great business. It was fun. It was a sales operation. I managed the entire sales floor while working on technologies to automate the marketing and generate inbound lead flow. And that's kind of where I got my love for tech. Um, and I was able to kind of continue to learn and educate myself on how tech is imperative to growth in the financial space. So fast forward to 2017, things were going gangbusters and the company was doing really well. I wanted to get back into funding. So American Allied Funding was the we were funding first. I was a funder before I was a broker, but decided to go back into funding and do it my way. And things really went well. We were really focusing on funding the deals that we were generating internally through the marketing efforts. And we had full control of the client. That was the beauty of that model. But then COVID came around and nobody knew what tomorrow was going to bring. And we just, I lost my entire sales floor at that point in time. So I had to make a decision. What do we do? Do we, pick up and do something else? Do I focus on funding, which was doing really well, but it was limited in scope because it was only being generated off of internal operations, internal sales? Or do we, try to do both again? I decided, you know what, this is an opportunity. Let's not rebuild Excel and just focus on what would be, the main income provider. What would be the biggest, I guess, most bang for the buck, if you will, which is funding. I decided to not let anybody come back after COVID, and we were actually the first company to start funding during COVID, and that's what actually helped us excel to where we are today. We started funding in June 2020, when most companies didn't start till November, December. So we were able to gain a lot of market share really, really quickly by going really heavy on the marketing to brokers saying, hey, we're funding, and they had no option to send their deals to. And then throughout that process, we've invested heavily into technology, which is something that's, very important because the competition is extremely heavy, and if without technology, you would need 10 times the workforce to produce the same amount of generation that we do.
Okay, yes, I hear you on the technology, and we'll dive into that later. Let's talk specifically about your current service offering with GCM Capital. So I saw two things. So you it looks like you partner with, first of all, you provide funding solutions or capital for businesses. And there's kind of two options. Option one is you partner with them in terms of kind of a revenue share agreement. And then the option two is kind of the MCA portion. Maybe just kind of describe kind of how that works from the business's perspective, that service.
Sure. So as far as the purchase line product, it's very similar to a line of credit, and the way that it works is they're approved up to a specific amount. So let's say the client's approved up to $1 million, they can draw anywhere from $10,000, which is our minimum, up to the full $1 million. And as they're making their remittances of the receivables, they're allocating additional funds to be drawn at a future date as they please. And that product is very flexible in the sense that most companies don't allow them to prepay with MCA style products. With us, there's a set discount that's allowed that they get for every 30-day period. So our rates start at about 2% per month for the cost of capital. So if a customer is you holding the capital for only 30 days, it's very similar to Factor, actually cheaper than a lot of factors, where they pay the 2% for the cost of capital for those 30 days. The profit share percentage that you're referencing there, that's the way the brokers get paid. So we do work with many, many brokers who send us all of our deal flow. Like I said, we axed Excel during COVID, and it's not something that we're looking to restart in the near term. And the way that the brokers make money is they get a profit share from the money that we collect every single month, and that goes to pay them. So in regards to the profit share, that's specifically to the brokers. with the merchants or businesses that we're funding, they're paying that set monthly discount for the holding period of the capital.
Okay,
And
great.
then, yeah, and the way that it's repaid, it's a percentage of their revenues that we purchase. So, 5, 10, 20, whatever, the math comes out to, we purchase that amount and we collect, X amount of their revenues to get our capital back.
Okay, excellent. And in
Yeah.
terms of your clients, you mentioned merchants. Does that cover retail, food and beverage, e-commerce, or is it a specific niche?
So yeah, good question. As far as like the merchants or businesses that we're funding, I would say we fund 90+% of industries that are out there. Right now, we're not funding trucking just because of this historical default rate associated with that industry. Honestly, don't know why it is. They have commercial AR, they have good businesses, they have repeat clients, but for some reason, it just doesn't work. I mean, it's like you're talking about a default rate that's well over 10% on those deals. We did them,
Wow.
we tried, but it
Hmm.
just never works out.
Hmm.
I would say the default rate's probably closer to 20%.
Ooh, that's
Yeah.
one of life's great
Yeah.
mysteries. Okay,
Yeah.
what's up
And
with
it's
that?
and then the other industry with the same kind of conundrum, if you will, is car sales. Again, great businesses,
Mm,
money making operations, but
mm, yeah.
default rates are through the roof. But everything else is fair game. We fund cannabis, we fund accounting services, we fund I mean pretty much every other industry. Thinking of what else do we decline? It's really about revenue. We look at the
Hmm.
revenue. So if a business is doing like, you know, 20K a month, we're not going to fund it. Our minimum is 50,000 a month in revenues, and we
Okay.
found that these type of financing products are better sustained when there's more cash flow. Obviously, if a smaller business has it gets hit with like a large expense, it tends to really put a damper on their operations. When you have these bigger businesses, not that big, but bigger businesses, they're able to sustain first off the remittances that they have to make to us, and then the other business, uh, any other business disruption that they have to deal with temporarily.
Okay, great. Well, thank you for that. That was an excellent kind of overview of your structure. So now let's kind of shift to a topic of interest, right? Obviously, my company is a technology solutions provider, but maybe give us a little insight on the role of technology, kind of what it's played and kind of what it's evolving into for your specific business.
Absolutely. And that's my favorite topic. I love technology, and I've immersed myself into it over the last 10 years, but ever more so in the last like 5 years. So yeah, technology is literally everything in our
Mhm.
industry. It helps us facilitate the speed of the transaction, the underwriting process, closing, deal origination, not even deal origination, but inputting the deal information to have it in our system and the closing process associated with it, the accounting, the statements. So yeah, so with technology, we've created our own software. We've been working on it pretty much since we decided to go full force into funding in 2020. We said, hey, we tried a bunch of SaaS companies to help with the underwriting automation, but none of them were exactly what we wanted. So I had the tech background when I was doing Excel with the marketing automations, and decided to keep that team, the development team that we've had, and create our own software. The software does a lot and it's constantly evolving, but essentially it automates the full underwriting process from inception or from intake, if you will, to underwriting. So Arc software has the ability to take a statement, digitize it, as I like to say, upload the fields or deposits, all the transactions, highlight all the risk factors associated with the transactions, flag any kind of metrics that we want, So there's a lot of companies in the industry that offer debt consolidation, and they hide the way that they collect their money from merchants. So that, we have a database of all of those companies and how they pull their debits. So we're able to flag any uh, debt collector or company. Essentially, it's not really about the debt collector, it's about the merchant that used the debt collector to not pay another funder, you know?
Mm-hmm.
So all of that's automated. And when the OCR is reading the statements, it lets us know if they're making their tax payments. It lets us know how much they're paying other institutions, per week, per month, whatever the, recurring transactions are. Organizes the DSCR, organizes all the data so that way when the deal comes in, 90%, not 90, let's say 70% of the work is done, and then our processing team has only 30% of the work to do, which is, database research, which we're also going to implement an AI tool to do that. So that's kind of in the works. Yeah, and as far as like pricing the transaction, the system has learned to price transaction and offer a recommended approval. But unlike a lot of other companies in our industry, who do everything automatically, we do like that layer of human oversight. So we let the technology do majority of the work, but we want to double check everything and also have a human authorize the transaction or authorize the approval. So that way the brokers don't get mad, because what winds up happening in the space is things are fully automated and then only get reviewed by a human at the end, and the broker then gets really upset when there's something like a debt consolidate or whatever in the statement that should have been caught up front. And meanwhile, you've worked with this client to close for 3 days, 4 days, and then the deal died, and the customer gets really, the broker gets really upset that like the deal died for no reason or for something that should have been caught sight unseen.
Yeah, I completely agree. So financial services obviously is a very trust-based service, right? Still, and it still requires, although technology is great and it continues to evolve and make things much smoother, you still need that human interaction. Now, that said, you mentioned the very hot topic of AI earlier. So maybe provide us kind of some insights into what role AI is currently playing in your business model, maybe some things you're looking at or exploring with regards to AI, or any other thoughts you have on that specific area of technology.
Yeah, AI is hot and it is changing everything, I would say. Um, so yeah, as far as current utilization, it's pricing out the deals. It's giving us suggested offers. It's pulling data from the web and giving us a report, like a customer score, a public customer score. Um, and we're still training the AI to do more. And it's something that, we're hoping will continue to evolve to make our process faster and more efficient. And we're looking into having the AI read the emails, intake the actual submission, if you will, because currently with the way that the deals get submitted is via email. So we're looking to have the AI read the email, post all the data to the CRM to have that automatic underwriting process start from the email, from the time that it's submitted via email. So that way the organizational structure or the way that we organize our files won't need to be done manually via Google Sheets anymore. So right now, yeah, it's still a little archaic. It works, but when a deal comes in, we create a list of all the emails, and then they need to be answered and then inputted into the CRM. So AI is going to take all that data and automate that whole front end or intake process completely, instead of once it's already in the system, and then it
Great.
will give us a
Yeah.
score.
Yeah. That's another one of those enablers that builds capacity. So that's great. Talk to us a little bit, Nathan, about your business, specifically GCM Capital. Talk about some of your big wins, but then also talk to us about maybe some of the challenges you faced and you're currently facing in your business.
Sure. So let's start with the challenges that we're facing currently. It's not related to tech. But we are seeing an uptick in default rates over the last year or so. Consumer confidence, I think, has a lot to do with it, where clients just are not fighting, through the hard times as much, and just decide to like throw their arms up and say, "Hey, we don't want to continue." So we're being more cautious in the way that we're processing our deals. We've had to, tighten our underwriting guidelines because of that. We did, I guess, it started in Q3 25, where we started noticing that, clients are having a harder time keeping up. I guess the stimulus ran out. I mean, it's been a couple of years, but um, yeah, it seems like businesses are having a harder time now than in my last 10 years to keep things going. I know the numbers in the market don't really reflect that. The stock market's like going through the roof, and the big companies are doing fine, but it seems like a trickle effect. So the money that's coming in is going into the larger companies and running out when it's getting to the lower tier of the companies doing under 10 million a year, which is our primary candidate for funding. Um, Other challenges is everyone is trying to deploy capital. It seems like, you know, there is more funders than ever looking to fund the same amount of businesses, less businesses really, because a lot of them have seemed to, you know, fold. And the price competition has been ridiculous. Honestly, it's you know, everything is going longer and everything is getting cheaper as from a funder's perspective. So for us, when we're a private company with private funds, uh, it's tough to compete when you have companies like On Deck or Capitus or any of the other companies that have large pools of capital that are basically at zero cost or close to zero cost. That being said, we do offer the personal touch to a lot of the deals that we do, and we're very flexible with the way that we arrange our payments or remittances, and that's been a big reason why the customers like to work with us. And our pricing is aggressive, but again, it's like every month we're like, oh my God, how are these guys going so cheap? How are these guys going so long? Like PayPal, is another main competitor of ours, and they're like going at 9% a year for a lot of clients, and mortgages are close to that. So
Mm.
it's like
Mhm.
we think like, are they doing it just to continue to capture market share and hope that the economy gets better? Because I'm sure they're dealing with the same default increases we are. Um, Other than that, I mean, we've been doing really well. The wins, the technology has been amazing. We've grown our company year over year by at least 20%, and we haven't really had to hire. I think we've hired like two new people in the last year or so. So we're able to scale, and we're at a point where we're able to scale aggressively, without having to hire a tremendous amount of more people because we've automated so many processes within the organization. Um, we've also been able to maneuver around the evolving regulatory landscape, which is something that we're very proud of. We're compliant with all the states that require compliance. We've made it a priority to make sure we stay that way, and try to outdo our competition by being able to fund states like Texas or states like New York, where there's been severe regulatory compliance changes in the last 12 months. And I think that's one part that's actually helping us continue the growth because many of the companies in our space have just decided to not fund those states. So we've seen a huge increase in intake in Texas, which we love the state. Businesses are doing great there. One of the few states that's really booming still. Other wins that we've had, I mean, we've been in business for a long time. A lot of companies that started before me, have ceased to exist. And that's because of our extreme, how would I put it? Extreme focus on compliance and doing the right thing for our clients. We don't have any complaints. We've never been investigated. Uh, we never did anything wrong to any of our merchants. We're full of disclosure. We're full disclosure with every single piece of our transaction process, and that has helped maintain our great relationship with a majority of our clients, and that's how we see repeat business. I mean, our retention rate is through the roof. We don't lose so many clients because one, we like to be hands-on. We keep a personal relationship, and we do the right thing for our clients at the end of the day. We don't try to, take advantage of anybody.
Great, great. So, just one final question, Nathan, if you would. So you mentioned your stated goals. You know, you've got a high retention rate, 20% year-over-year growth. But if you could maybe just pick one thing in your business that you could fix or optimize that would enable that growth, what would it be? Would it be technology? Would it be what do you suppose that would be?
Tech, it's going to go back to tech at the end of the day. There's still processes that we're working on to automate that are complex. Our portal is live, so users can, do what they want when they want, see what they want when they want. But I think tech is always going to be evolving, so we're always going to try to be on the forefront of it. Like you said, with the AI, things are always changing, so we're always going to be looking to adapt to the newest technology. We might want to focus on direct marketing again because of the higher default rate with the brokers. We don't know if it's because of them shopping them out and then they're getting called from a bunch of different funders, but it's something that we're very seriously contemplating, is to start a direct side. So that's a piece of growth. That's a whole new business basically that we would start again. Um, but as far as focusing, it's really just growth, technology,
Mhm.
and
Mhm.
marketing. Um, the growth has been hard. I'm not gonna lie. Like, it's been very hard to, generate more deal flow
Mhm.
because of the competition. I mean, you have Intuit, PayPal, American Express, Shopify, you know, and the list goes on of these giant companies that are trying to take market share. I mean, these companies are funding I think $1 billion a quarter, each one of those. So for companies like ours, we only have like 20 employees. We're not doing direct marketing, which each one of those companies are. It seems to be harder than ever to compete.
Yeah, yeah, I hear you. Um, but I think technology does enable kind of a leveling of the playing field when
It's
leveraged
cheaper
properly.
than ever.
Yeah.
Yeah, it's also cheaper than ever to implement with AI. Or just ask GPT, hey, make me a marketing pitch for my business, and
Yeah.
find a lead company, and then, let it
Yeah.
do everything
Yeah.
for you.
Yeah. It's great.
But
Okay. Well, Nathan, thank you so much for being here. Any closing thoughts for the listeners today?
um, just not really. Just, things are getting complicated, but they're also getting simpler. So for anybody who's, starting a financial technology company, I think it's easier than ever to actually get into the space because of the technological advances that are happening. There's a higher barrier to entry with the compliance, but to actually get deals done, get deals submitted, uh, and create a marketing channel, I think it's never been an easier time in our existence, obviously. And if you need working capital for your companies that you are working with, you could always reach out to gcmcapitalgroup.com. That's our website, and check out our product. And that's it.
Great. Great. Thank you, Nathan, again for being here. Really appreciated talking to you and really enjoyed what you had to say. So that's it, folks. Check us out online, gcmcapital.com, fluxianaisolutions.com. Visit our YouTube channel, FinTech Forward Podcast Series. Like and subscribe. Thank you for joining us today. Until next time, be well.
Thanks, Steve.